Hello and welcome to Stock Market Fever. Today is Friday, June 10th, and in the spotlight is Docusign. Docusign shares absolutely tanked after the close yesterday, and in this video we'll review where Docusign has been, why it crashed, and where it may be going after the dust settles. And you'll absolutely want to stay tuned to the end as we at Stock Market Fever wrap things up and offer our own opinion of where Docusign may be heading going forward. Let's begin by looking at Docusign before the COVID pandemic. For the last 3 years, in the face of people doing more and more business from home or online, Docusign revenue had been growing in leaps and bounds. Revenue had in fact more than doubled through the fiscal year 2020 through 2022, soaring from $1 billion to just over $2 billion. And with that revenue growth came great earnings growth. Docusign NonGAP Earnings grew exponentially from 31 cents per share all the way to $1.98 in 2022. And with that earnings growth came massive share price growth. From the end of 2019, when Docusign was trading just above the $50 range, Docusign's share price exploded, hitting a high of over $300 per share in the middle of last year. But then the stock started a deep decline, dropping to about 157 as the market opened this year in 2022. And yesterday, June 10th, after Docusign reported first quarter non-GAAP earnings of 38 cents per share adjusted versus 46 cents per share as expected by analysts, the stock dropped significantly in post-market trading and in fact is now trading from Thursday's close by a whopping $18 per share down at $69 per share for an astounding 20% loss of share value overnight. The market has been brutal to stocks that miss their earnings mark or provide low guidance this year. Witness the huge drops in formerly stalwart high flyers such as Netflix, Facebook, now Meta, PayPal, and many, many more. And thus, Docusign plunged downward. How low will it go? Well, let's take a look at what industry analysts declare. As of May 2022, out of 23 analysts covering Docusign, there were 12 buy or strong buy recommendations and 10 hold recommendations. And even as of this month, June, there were still 5 out of 8 analysts recommending buy or strong buy, and they had set an average price target of 116. Well, now, with the stock trading around $68 per share, maybe we shouldn't turn to industry analysts for future forecasts on Docusign. Well then, what do we at Stock Market Fever forecast for Docusign? We'll be glad to tell you in a moment, but if you like this video and would like to see more like this, please click the like button and subscribe to receive future stock market news, analysis, and alerts right here at Stock Market Fever. Thank you very much. Okay, back to our forecast. While we do not offer investment advice, we gladly offer our opinion. And in our opinion, Docusign was highly overrated by industry analysts who were dazzled by the company's non-GAAP earnings growth while ignoring the undeniable series of losses when earnings are reported by GAAP. GAAP, of course, stands for Generally Accepted Accounting Principles, and companies will often adjust and report both non-GAAP and GAAP earnings so that special one-time events, such as a company buying another company or the payment of stock options to early employees, doesn't create a false negative impression of a company. We often see differences, but not major differences, between non-GAAP and GAAP earnings, and when explained with footnotes, analysts can come to their own conclusions. But with Docusign, there were, in our opinion, substantial differences between non-GAAP and GAAP earnings, and these differences were not satisfactorily explained, in our opinion, by the company's financial footnotes. If you were to look at non-GAAP earnings, for example, Docusign had annual profits of 31 cents per share in 2020, 90 cents in 2021, and $1.98 in 2022. But if you were to look at GAAP earnings, Docusign actually had losses in all three reporting periods of $1.18, $1.31, and 36 cents. Why such a big difference in results between GAAP and non-GAAP earnings? Some of it can be explained in the form of purchases of property, plant, and equipment, but too much of it, in our opinion, is in the form of stock-based compensation. In 2021, Docusign paid out over $286 million in stock-based compensation and over $400 million in 2022. Folks, the fact that Docusign is consistently paying out enormous sums to their employees to generate revenue indicates that there is fierce competition for quality talent to develop, maintain, and market Docusign's offerings. The fact that they are doing this consistently indicates to me that their non-GAAP earnings report does not clarify their earnings, but rather underplays their significant expenses in generating revenue, and that Docusign is more accurately considered by GAAP reporting. And in GAAP reporting, Docusign has simply not been a profitable company. Thus, in our opinion, the prices where Docusign have been trading are not justified, as the company has been losing money. And thus, we do not believe Docusign should be held, as the stock could decline significantly further, perhaps into the $40 price range. This is what we think. But what do you think? Where do you think Docusign is headed in the short run and long run? Would you recommend buying, selling, or holding? And why? Please leave your thoughts and comments below, as we'd love to hear from you. And please be sure to like and subscribe to Stock Market Fever for future actionable stock market news, analysis, and alerts.